to say thanks for signing up for this. This is now briefings 9 and 9A, which are about money and finance. And Josh Ryan Collins from the finance and business team is going to take us through it. And he's probably the best placed person to do it because he's a co-author of a book called Where Does Money Come From, which is obviously a very, very key question. So without further ado, I'll let Josh get started. And just to remind you to use the chat box in the bottom left corner of your screen if you have any questions, and I'll write them all down and we can put them to Josh at the end of the presentation. So over to you, Josh.
Thanks very much, Chris, and welcome everybody. I'm going to talk about money and finance, key issues in our modern economy, particularly as we've all seen in the light of the financial crisis of 2008. Just to give you a general overview, I'm just trying to move my slides forward here, but it doesn't seem to be working. There we go. I'm going to start off by defining finance. Then I'm going to talk about these key elements: money, banks, credit, debt, and interest. And then I'm going to talk about problems with the current system, lay out some alternatives, and talk through one particular case study. So what are the functions of finance? At NEF we've defined finance as being about the facilitation of creation and allocation of economic resources using money, credit, or other exchange instruments across space and time. And of course, being the new economics foundation, we've added to that in such a way that maximizes human welfare, social, ecological benefits. Now, what finance does is it really enables economic activity, and I'm going to talk more about exactly how that works. But it also has a number of other functions, and these include providing a payment system, managing uncertainty and risk, in the sense of, for example, providing insurance, and signposting people, particularly via the price mechanism. The financial good, the price of a stock or share tells us information about the value of the company and enables investors to make decisions over time. So finance has a number of functions, and what's interesting is how these overlap and interact with each other. But I'm going to focus on one particular type of finance here, and that's bank debt finance, the first of those listed here. And this is borrowing, is popularly known as borrowing, mainly done by individuals and smaller companies, and the interest is charged in most cases. But there are two other kinds of financing that you will probably be familiar with. One of them is the issuance of bonds. However, this is limited to larger companies and governments, and it is term debt because the bond value can be used for a specific number of years. The interest rate will vary over time according to the demand for that bond, and it's highly tradable. The bond market is one of the biggest financial markets in the world, one of the most powerful and important, as we've seen with the Eurozone crisis. If the price of government bonds falls or rises, it can cause all kinds of problems. The other main source of finance is equity issuance, stocks and shares. Again, this is limited to larger companies. And one point I just wanted to make is that whereas with debt-based finance, if the company that's issued the debt or the company that's borrowed the debt fails, the onus is still on the borrower to find the funding to repay the lender. With equity, the risk is shared effectively. So if a company issues a stock or a share and somebody invests and the company fails, both parties will lose their funding effectively. So equity is sometimes thought of as a more equitable form of financing than debt, but it's debt that tends to dominate our economies, unfortunately, and I'll talk about why that's a problem not only in terms of social justice but also ecologically. So what I'm going to talk about is bank debt mainly in this presentation, because it is actually banks that play the most important role in the financing of capitalist economies. Now, this is not very well known. It's the reason that we wrote the book that Chris mentioned, Where Does Money Come From? The popular perception of the role of banks in the economy is as intermediaries. So typically you'll have savers who will deposit their savings in a bank, and the bank will lend these savings to borrowers. That is your stereotypical conception of the role of banks. And what this means is that banks would appear to be, although important in terms of their intermediation function, not critical to the running of the economy. One could imagine other kinds of financial institutions, perhaps insurance companies or pension funds, playing that intermediary role. What is it that makes banks different? One might ask. Why are banks so important in the financial crisis? Well, it's because this picture, this diagram I'm presenting here, is actually the incorrect description of how banks actually operate. The more accurate view I will demonstrate to you now. And this is, if you're going to take one thing away from this presentation, this is the key thing really. And that is that banks actually create money. They don't take other people's money and give it to investors. They actually create new money when they make a loan. And the way this works is demonstrated in the diagram. When banks extend a loan, this £100 loan extension, they at the same time create a deposit. Now the loan is the bank's asset, and the deposit is a liability of the bank. It's what the bank owes to me or you, or the person who's taken out the loan. No one else's money is removed from the system at that point in time. So that is the act of money creation. It's simply the creation of a loan. And of course, given that the definition of a loan is essentially the giving away of something that you have to somebody else for a period of time, lending is actually an inaccurate description for what banks do. A more accurate description would be credit or money creation out of nothing, essentially. And when you repay your loan, what happens is that asset is repaid, the loan is repaid. There's a minus on the left-hand side under the asset, and at the same time that deposit also disappears from your account. That is money destruction. So the money supply, that is what enables us to conduct transactions with each other in the economy, is determined at any one time by the total amount of outstanding loans made by banks in the economy. So it's the total amount of loans outstanding, that is the total amount of loans that have been extended minus the total amount that have been repaid. That is crucial in understanding how the financial system actually works. So that's in essence what makes banks different from pension funds or other forms of intermediaries, and why they're deserving of particular attention in thinking about how we might reform our economies. Private banks actually monopolize money creation. They create 97% of money in circulation. Only 3% is created by the Bank of England or the government as notes and coins. All the rest is electronic bank debt with interest charged upon it. The other key point is that banks not only create money, they decide where it goes in the economy. So a bank decides whether £1,000 goes into a mortgage versus a small entrepreneurial business versus giving a loan to a hedge fund, so the hedge fund can speculate on financial markets or take over a company. Banks make these decisions, and they thus determine the trajectory of the economy. The other key thing about banks is that they not only create and allocate money, but they also provide the payment system that enables us to make payments over time and with each other. And this is very important because it means that if one bank fails, there's a system-wide threat to the economy. If Barclays becomes insolvent, all of the obligations, the debt, the payment obligations that between Barclays and all the other 50 or so banks in the economy suddenly come under threat. And this is why the governments generally are very reluctant to allow banks to fail. This means that banks don't really observe the rules of the free market that you've probably been hearing about in previous presentations. They're actually subsidized by the government and underwritten by it. They are too systemically important to fail, might be an appropriate way of thinking about it. And deregulation since the 1970s, in particular under Margaret Thatcher in the 1980s, the Big Bang, has meant that central banks have increasingly less control over this credit creation process and this allocation process, and banks have been freed up to make decisions about where they allocate funding based on short-term profit. Now this creates two big problems. Well, it creates a number of problems, but I'm going to focus on two here. The first is that, as I mentioned, bank debt money, which dominates the money supply, is almost always associated, carries interest. So a bank will not make a loan without, in normal conditions, without charging interest sufficient that it not only covers the risk that the borrower will default on the debt, but also sufficient that the bank is able to make profit. Typically there'll be a spread in the interest between what the bank will give to you as a depositor and what the rate that the bank will charge when they lend to you. Now this can be, from an ecological perspective, this is potentially very damaging, because any firm in an economy where money is created as interest-bearing debt has to not only pay back the debt that's been lent out, the principal of the debt, but has to pay back an enhanced amount. It has to pay it back with interest. So that means that additional money has to be found by that company. Now that can only really come from two places. If the company's not going to go bust, it has to come from economic growth, an increase in GDP transactions, or it must come from inflation, an increase in the general prices in the economy. Neither of those things are particularly good news from an ecological perspective. Now, it's possible that with a certain set of regulations, highly progressive taxation, very low interest rates, and a closed economy where money can't leak out, this might not be so important, because those interest payments made to banks might trickle back into the real economy. So the profits that banks make, well, they're eventually spent on whatever bankers spend them on, although a small amount will be held back as banks' capital, which banks are required to hold. But in our current economy, we've got privatized, globalized, and, as I've mentioned, deregulated system, which has tended to lead to unsustainable growth. And what in particular we've seen, and major cause of the financial crisis, was the allocation of credit and money into what I would call non-productive sectors of the economy. And the next slide will show that, hopefully. So you can think about different types of credit creation by banks, or credit allocation. You talk about productive credit creation, where loans are made to finance real investment projects. A business is actually building something or creating a new bit of machinery or a new service. But a great deal of new bank money creation goes towards what you might call speculative purposes, loans to finance purchase of existing assets, whether they are financial assets like commodities or shares or derivatives, or physical assets such as houses. And then a lot of credit is extended for consumption. Finances us to buy things that ecologically may not be particularly useful, toys and cars and other products made in far off places with great environmental cost, not factored into their price. You've heard about externalities, I'm sure, in previous slides. But it's banks that decide which of those channels the credit is allocated to. And that, as the next slide will show, there has been in the UK, this shows the distribution of credit across different channels, different sectors since 1997. There's been a big increase in non-productive credit creation. The black line at the bottom is really productive credit creation, although we have the yellow at the top, which is government services. But you can see the growth areas are secured lending to individuals, the red, which is basically mortgage lending, and unsecured lending to individuals, a lot of which will be this sort of consumption-based credit card spending, and financial intermediation, which is banks lending to other financial companies such as hedge funds or other banks to speculate on the market. And real estate's also quite significant there. Now these sectors, they might contribute a bit to the economy, but what we really want is less of that and more of the black. But there's been very little evidence of that happening. And if we go to the next slide, we can see that from 1985 you have this disconnection of the total money supply, that's the red line, it's called M4, from GDP. Now what that means is more and more money and credit is going into non-GDP activities, such as mortgage finance, such as financial speculation. These kinds of activities don't actually contribute to GDP. They don't create productive activity, employment, or growth. And so something funny is happening here from 1985. Again, that coincides with the Big Bang under the Thatcher government, when there was this deregulation of the financial sector. The next slide shows really what happened since, in particular in the late 90s to the financial crisis, where you have this what's called an asset price bubble. Now, what happens here is, you can start anywhere, of course, on this because it's a self-fulfilling prophecy. But if more credit is extended at the top here for existing assets as opposed to new products and services, so more credits extended for an existing house, i.e. a mortgage, there's an increase in the price of that asset because there's no additional employment or growth being created, so there is an inflation in that asset. However, that leads to the expectation of future increases in asset prices, which in itself means there's increased borrower demand for credit. People want to get on the housing ladder. At the same time, where there's not credit losses, where everyone's confident, it increases banks' capital base because banks charge interest on their loans, and if more and more people are coming in to get their loans, there's more and more interest, there's more and more capital, they get favourable credit risk assessments, and they start increasing credit again. So you get this self-fulfilling asset bubble, which eventually will burst as the level of debt that people are having to pay starts to eat into what they can spend in the economy, and demand falls. So that's how that works. And that's really one of the key causes of the financial volatility we're seeing and the financial crisis and the house price boom that we're seeing today. From an ecological perspective, the current system is problematic as well. And a key reason for this is that just as lending to a small business might seem much less attractive to a bank because it's quite risky in terms of the probability that the firm might go bust compared to, say, lending against mortgage prices. So with investment in low carbon infrastructure or ecosystems, the short-term profit is not significant enough to outweigh the potential risks associated with those kinds of investments. And banks really have no incentives to invest to create credit and money for ecological activity, ecologically beneficial activity, because the profit is much longer term and the risks are still there. So that is a serious problem when you think about the overall dynamics of the economy. The next slide will think about some alternatives to this. Now, the alternatives you might be more familiar with are around regulatory or market-based fixes, carbon taxes, subsidies, trading. Now, these could be effective, and I think there's evidence China is progressing with these, and Germany has also had some achievements, but they will take time to bed down, and many of them will require, as I'm sure you're aware, international agreements that take significant amount of time. And in particular, taxes and subsidies, as we've seen with the current example in the UK with green energy, the green energy tariffs on energy bills, they're very difficult to get popular approval for those kinds of policies at a time where we have austerity and governments making cuts in all kinds of places. What's actually required to rapidly transition to a low carbon, sustainable economy and an ecosystem that's sustainable is a very large, if not massive, flow of capital to the areas where it's most required. We haven't really got time to wait around and hope that this system that I've explained, this highly dysfunctional credit creating system, improves itself. So I'm going to suggest some perhaps more radical alternatives now that we have been promoting at NEF. The first one is simply public banks. Now, public banks don't have a very good press. They're often associated with high levels of inflation and pork barrel politics, perhaps. But in reality, public banks have played a key role in developing countries' economies. If you look at East Asia, they've been absolutely key there in stimulating innovation and industrialization. And we do actually have two public banks in the UK, the Green Investment Bank that you may have heard about and the Business Investment Bank. But actually these aren't really banks because they can't create credit in the way that I've described earlier in the presentation. They are just actually intermediaries. They take private sector money, the government matches it with a bit of money from the taxpayer, and that's given out for environmentally friendly projects. They don't create credit in the way I've described. And they're absolutely tiny when you compare them to our competitors in Germany, Brazil, and China. I think I've got a slide. The next slide will show the difference. You can see there, this is the balance sheet as a percentage of GDP, percentage of the total economy in these four countries, and you can see the UK on the right-hand side there, the Green Investment Bank and the Business Bank, considerably less than 1% of GDP. When you compare that to Germany, the public investment bank there is closer to 18%. So there's a big gap in the size of these kinds of institutions. Now, another alternative is, which we've been promoting, is you look at quantitative easing. Quantitative easing has involved the Bank of England buying government bonds, which I talked about at the beginning. That's bonds issued by the government to fund the government over a period of time. It's normally 1, 5 or 10 years. And the bank has created new money. The Bank of England, just like a normal private bank, can create money effectively out of nothing, and it's created 375 billion to buy those bonds. And what we're suggesting in NEF is they could use a proportion of that funding to buy bonds in the Green Investment Bank, to finance ecological infrastructure projects, whether it's wind farms or insulation or solar panels. Equally, that money could be used to support ecosystem infrastructure and preservation projects, whatever the mandate was that the Green Investment Bank had. This would be beneficial in a number of ways. The key one would be it wouldn't raise public debt because it would be a loan effectively from the bank. So it's not government money, it's not tax money, it's not costing anyone, it's not taking money from anywhere else in the economy. It's credit creation by the central bank. And we would hope it would create jobs, help us meet our carbon targets, etc. And it shouldn't be inflationary either if that money goes into parts of the economy which has spare capacity. If we build solar panels or insulate homes in the northeast where people don't have jobs and we give them jobs, there's no reason that will be inflationary. The third alternative I'd like to discuss is credit guidance. Now, this is historically very commonly used previous to the sort of neoliberal revolution of the 1970s and 80s. And what it involved was central banks and governments essentially putting constraints on the lending that banks could do. So typically you would have banks saying central banks telling banks that you can only have a certain percentage of lending for mortgages. You can have a much larger percentage for export sectors, because what we want to do is make stuff and sell it abroad. That will help us create sustainable growth. And in East Asia this has been particularly used. It's still used in China today. It's quite normal. There are different ways of doing this, and I won't go into this in too much detail, but you can have different leverage ratios or capital adequacy ratios, i.e. the proportion of money that banks have to hold against particular types of loans. So if it's a ecologically damaging kind of loan to a fossil fuel company, then banks have to hold much more capital or money against that particular loan than if it's a loan for solar panels or ecosystems preservation, where they would be allowed to have a much higher leverage. At the moment, all of those are the other way around. They all favour non-ecologically beneficial activities over more beneficial activities. One challenge with this is it may require international capital controls. The fourth option is actually nationalising the money supply itself. This has been a policy that's come back into favour in recent times, and it's really based on the insight that the credit market, just like most markets, is not perfect. People don't have perfect information. In fact, there is systemic asymmetry of information. Typically, if you're lending to somebody, you know much less about what they're going to do with that money than they do. The borrower always knows more, so there's always an information asymmetry. That means that the lender effectively rations the amount of money according to the risk that the borrower offers. There isn't this simple supply and demand model that you'll see in neoclassical accounts of the banking system, which means that banks and money can effectively be excluded. And even free market economists felt it was more sensible for the government or the central bank to control the issuance of credit in what's called a full reserve or 100% reserve system, where all of the deposits are backed by reserves in a public central bank. And it was felt that this would be a much more stable system. Obviously that would put much more power in the hands of government to decide which areas of the economy were most in need of new money and new credit, rather than leaving it to private actors in the shape of banks. Now, the fifth alternative I'm going to briefly touch on is local or regional currency systems, where we've also done a lot of research here at NEF. And the key point here is that money has always been a social relationship. It's not a commodity, it's a relationship of credit and debt, and really the outcomes of economies are determined by the power relations between creditors and debtors. And what we've seen through history is that where the sort of centralized banking, the centralized monetary systems, whether it's government or private bank systems, fail, local money systems will come in and enable people to carry on exchanging goods and services, which is what money essentially enables. So we've done research on a number of these kinds of programs, including mutual credits, where actually credit is issued based upon the spare capacity, the productive capacity of a business. So if a business has, goods and services that it's unable to sell, it can issue credits to other companies to buy those. If another company needs those goods and services, it can access these credits, and goods and services can carry on being exchanged. But you could equally back credit issuance by the biocapacity of an ecosystem or a region, a bioregion, or the energy, productive energy, renewable energy production capacity of an area could equally be used in that way. And developments in digital communications really bring down the cost of these alternatives. I'm going to finish now with a case study which looks at public banking and renewable energy in Germany to illustrate how what I've been talking about, which might seem quite abstract, really is possible and happening today. I hope most of you have heard of the Energiewende, energy turnaround in Germany, which has really raised the bar in terms of what's possible to achieve in terms of renewable energy in a very short amount of time. It's also been a great creator of jobs. If we see the next slide, you'll see what a difference that's made in terms of employment in Germany. You can see the green back in 2005 was about similar, 175,000 jobs in renewables versus non-renewables, and that's been a massive expansion. 2008 and 2011, it's double. This renewable energy turnaround is actually creating jobs and creating growth. How have the Germans managed to do this? Well, a key way in which they've managed to do this is through a public bank called the Kreditanstalt für Wiederaufbau, or KfW, as preferred to say in English. And this involves and this bank has, as I've shown, accounts for 18% of its assets, account for 18% of GDP. It's really, really big. And this has enabled the Germans to get the capital at low cost, very low interest rates into wind farms, into solar panels, into home insulation. Because these costs are very high interest, the upfront capital costs associated with wind farms, with solar, etc., are the reason that they are not competitive with nuclear and fossil fuel forms of power. And so, but the only reason for that is because we have private banks creating that money and charging that very high interest rate that always tends to be charged on big infrastructure projects which are at relatively high risk. So in Germany, they've simply solved that problem by having a public bank which will make loans. Actually, what it does is it subsidizes existing local and regional banks for loans that are ecologically and socially desirable. So the criteria upon which money is being created is a criteria that supports ecological and social activity, quite the inverse to what we have here. And this has been a huge success. If you contrast this approach to the UK's Green Deal that some of you may have heard of, well, if you want to get your windows insulated with the Green Deal, you're going to pay 7 or 8%, which contrasts to 2% for the typical loan in Germany for equivalent type of activity. And I think we're almost at the end. Yep, summary. Banks create and allocate new credit and money in the economy. So banks' decisions, your bank manager's decision when you go into a bank next time and ask for a loan, that decision is determining at a macro level the trajectory of our economy. And following many years of deregulation, we've seen banks becoming bigger and bigger, competing over, needing to generate bigger and bigger returns, quarterly returns to their shareholders. and incentivized to lend against existing assets, which are safer and give them higher returns, or financial speculation, rather than projects that would support the long-term ecological and social sustainability of our economy. And our thinking at NEF is it's not enough to use tax and market-based policies to change this. We need to reassert, I suppose, democratic control of the money creation and allocation system. Now that can be via public banks, it could be via credit guidance by the central bank, or it could be nationalisation of the money supply, or even it could be support for local or regional currencies. But we do need to do it now in order to meet the challenges that we face. And that's it. Thanks very much.
Thank you very much, Josh, for a very clear and coherent presentation. We've got one question, if you've got another couple of minutes, please, from David Rodriguez at the University of Plymouth, who asks, is money creation by banks backed by any commodity, gold for instance, or just based on confidence?
Hi, David. No, there's no gold backing of it or any other commodity backing of money that banks create. It is, as you say, purely confidence essentially, and this is why banks tend to charge quite high levels of interest, because they have to cover their backs really that the loan will be repaid. Money did used to be backed by gold, but it really hasn't been since 1971, really, when Nixon took the US off the gold standard.
Thank you. Does anybody else have any questions for Josh? Or feel free, if you're thinking about this afterwards, feel free to email me and I can find out for you as well. No? Okay, in that case, thanks very much, Josh. Thanks for your time. And I'll send you guys the links to this afterwards. Thank you.